Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, the House and Senate passed a continuing resolution avoiding a government shutdown that was set to occur at midnight tonight. New CPI inflation numbers are released for October. So just how are these higher interest rates affecting our buying power? If you've tried filling your gas tank this week, we've got some good news for you. And with Black Friday 1 week away from today, how will shoppers be spending this holiday season? And what is the state of today's consumer? Will we see the ending of higher interest rates but a slowing of the economy? Tonight, we're going to be talking with Scott Wren. Scott is the Senior Global Market Strategist for Wells Fargo. Scott Wren, he's coming up tonight. We're glad you're here for this next 28 minutes, and this is Wall Street Wrap-Up. Hi and welcome. I'm Andre Laborde on this Friday, November the 17th. A big show ahead, so we're glad you're here. Well, the House and Senate late this week passed a continuing resolution to extend government funding on some government agencies through mid-January and others through early February. Democrats agreed because it kept spending at the same levels, and the Republican Freedom Caucus members, well, they voted against the bill because it lacked spending cuts. The president signed the CR late last night, avoiding a shutdown for this evening. It's sort of like the Henny Youngman joke of the doctor telling the patient he has only 30 days to live, and the patient says he can't afford the bill, so the doctor gave him another 30 days. So in January, we're going to be right back where we are today. October's CPI was released this week, and with higher interest rates, it is slowing down the economy. We were expecting a CPI year over year at 3.3%, but it did come in lower at 3.2%. Well, that caused the markets to rally. The core CPI, which excludes food and energy because those two areas are considered the most volatile for the month, that came down and rose only 0.2% month over month. So with inflation right now at 3.2%, both food and shelter are still higher than 1 year ago, with rent the highest at just over 6.5%. Energy is a big winner, though, and especially gasoline. If you filled up your tank this week, you might have been somewhat pleased that gasoline prices have gone down some. I admit only maybe some pleased. WTI crude has dropped to $75 per barrel, down 13.5% from 30 days ago. Natural gas is down 5% from 1 month ago, and this is all due to many different reasons. Well, because of this drop, this may have been showing up on your gas prices at the tank. Today, the national average is just under $3.50 per gallon, and that's down about 10 cents from 30 days ago. So enjoy it while we can. Well, how did our money do this week? It was the third consecutive positive week for all of the indexes, and the top sectors for the week were real estate and materials. And the Russell 2000, which are small cap stocks, they were up 5% for the week, with oil having its fourth consecutive weekly decline. Well, this week, Dow Jones closed up just under 2% for the week. S&P 500, they closed up just 2.25% for the week. And the NASDAQ, they closed today up just 4.25%. About 1/3 of workers, well, they don't have access to retirement plans from their employers, and women work more part-time than men. But a new law and a demand for employees may change those numbers. Starting on January the 1st, the federal law is going to require that 401k plans will allow part-time employees to participate in the company 401k plans. Employees do need to work a minimum of 500 hours per year for 3 consecutive years. But as of 2025, that 3-year minimum is going to be dropping to 2 years. And with the extra tax credits available for employers, they may also make it easier for businesses to include part-time workers into their company 401k programs. Well, with 38 trading days left in the year, will there be a Santa Claus rally? Next Friday officially starts the holiday season. And with prices, car insurance has surged over 19% and doesn't seem to be slowing anytime soon. But the good news is inflation seems to be easing with no signs of a recession. But with Black Friday just 1 week from today, many retailers are concerned if consumers will be as strong this year as in the past. According to a recent report by Apollo and CNBC, hiring this holiday season is going to be the lowest in 2 years, with 2023, this year, part-time hiring to be around 135,000. Now, that's down 4.2% from last year, and it's down 35% from 2021. So will consumers be buying as much this year as in the past for holiday season? How will stock market surge since November the 1st affect the remainder of the year and into 2024? So is a recession still on the menu? Tonight, happy to have the Senior Global Market Strategist for Wells Fargo, Scott Wren. Hi, Scott. Welcome to Wall Street Wrap-Up.
Great to be here, Andre.
Scott, since the beginning of the month of November, the stock market has been on a tear. It's rising. And I'm curious, I remember watching a show you had done, a financial show, maybe about 4 or 5 weeks ago. And you had said that you were advising your clients to hold and wait for a pullback before going into stocks. Now, admittedly, that was like 4 or 5 weeks ago. But now that the market has been for the last 2 weeks of November have been great. Are stocks, do you think, still a good buy, or do you think that they're now overvalued?
Well, I think right now, we would not chase this rally, and certainly we've had some pretty good trading sessions here since that October 27th low. So for us right now, valuations are stretched. We think there's lots of headwinds out there. We still aren't convinced that the Federal Reserve's finished hiking interest rates, but needless to say, we think there's probably some more downside here. And so we're cautioning our clients to remain defensive, but certainly have a plan. And when you get these pullbacks, maybe down to the 4,100 level or maybe even a little bit below, you need to be ready to step in.
Well, Scott, that's interesting because for 2023, the Federal Reserve has just one more meeting in December of whether to raise, pause, or lower interest rates. What are your thoughts are they going to be doing for December's meeting?
Well, I think after the CPI number, they're probably not going to do anything in December. And now saying that, we officially had one more rate hike penciled in here, either in November, which obviously didn't happen, or in December. So it looks like the news that we've had on inflation, at least for right now, probably doesn't mean that we're going to see a rate hike in December. But once again, Andre, I think the important thing is, it's all well and good that core consumer price index and the core personal consumption expenditures, which the Fed likes, are all right at 4% or just a touch under. But you have to remember that's still too high for the Fed. And if we get hung up at those levels, it wouldn't surprise us at all if the Fed hiked rates further.
Do you think that because they also don't want to be I'll use the term dovish, that they'll go, we'll just do another 25 basis points earlier next year, middle of next year?
I think the last thing they want to do is appear dovish, and I think one reason you saw Chair Powell come out last week with a little more hawkish type of tone is because they were not happy with the stock market rally that we saw after the last monetary policy meeting that ended on November the 1st. So they didn't want to see that kind of an equity rally. They didn't want investors and the general public to get any kind of impression that we're finished hiking rates or we're dovish or anything like that. So I think that's why you saw Chair Powell come out and talk a little bit tougher. And the market, reacted to that very temporarily. That's when we saw that October 27th, we were down near those lows after that FOMC meeting. But here we are back higher again. And so I think the Federal Reserve is going to continue to talk tough. They don't want us to think that, hey, it's we're finished hiking here.
Well, you've got registered investment advisors, stockbrokers, and people who advise people on investments that are maybe, say, 30 years old or so, that have no idea of interest rates to be normally at 3%, 4%. even 5%. They're just used to zero. Do you think the days of it going back to the zero are now over with, that they'll always want to try to keep some interest rate on the table for people, that money does have a cost to it?
Well, I think that if we see zero again, something really bad has happened. And so I would like to not think that every time we get a run of the mill recession, whatever that is, because we haven't had one in a while, but when we do, that the Federal Reserve would lower interest rates to zero. I think that's a bad policy. We're seeing a higher federal funds rate. So what I'd like to think is that, as we look out a few years here, we're going to have a federal funds rate that is at or slightly above a more neutral rate, and that the yield on the 10-year is going to be more attractive than certainly than it was a year or two ago.
Just recently, I'd say in the last couple of weeks, that when the treasuries were paying 5% yield and even higher, they were moving money from their money markets, or maybe even selling stocks, because at that time the markets were down in September and also October, and they were putting it in treasuries. Well, now that you've got the markets that are rallying right now, do you think that there's a FOMO, a fear of missing out, where you might have investors to start pulling out of treasuries and other types of yielding instruments to put it into the stocks?
I don't get the feeling that the fear of missing out is really gripping investors yet. It will at some point, but I think the market needs to be higher than where it is right now. And of course, you have a lot of conservative investors. The 10-year yield hit levels we hadn't seen since 2007. I mean, we've been recommending that you lock in some of these longer term interest rates. We've been parking cash in the short term fixed income market, because 3 month, 6 month, 12-month bills all yield over 5%. So that's a good parking spot. And what we're trying to do is wait for the pullback, and as the market pulls back, then we take some of that parking spot money and get it back into the equity market. So for us, I think that at some point you're going to see that fear of missing out in the stock market, but I don't get the feeling that it's started yet.
Well, normally November and December, whatever normal is in Wall Street, has always usually been good. So do you think that there may be maybe some rough times ahead, but do you think that would be after January the 1st? Or do you think that we still might be in for some rough times between now and December 31st?
Well, we're looking for, a recession probably starting in the early months of next year. So for us, the market between now and the end of the year probably doesn't have a lot of upside from here. And we would expect it if, the market was lower than where we are now by a few hundred points in the S&P 500. That wouldn't surprise us at all. As a matter of fact, that's more or less what we expect. So I think that the year-end rally, we've seen the bulk of it. That's not to say we might not in the very near term trade a little bit higher, but for us, we're going to run out of steam pretty quick here, and we're looking at a slower economy, earnings that are probably estimated to be too high by the consensus. Continuing manufacturing deterioration, that services sector of the economy that's held in so well, that's slowing, and we expect that to not be much of a push. Consumers, really don't have that much more money left to keep the spending train going. They're running up their credit card debt. It's over $1 trillion now for the first time, as you and many of your viewers know. So I think there's enough headwinds out there that we're going to put on the brakes, not too much higher than where we are right now.
Well, at one time, and this was going back about maybe 4 or 5 weeks ago, might even been 6 weeks ago, I remember watching you, and you had said that that you thought earnings estimates were too high. Well, now we're almost finished, for the most part, third quarter earnings, and we're now into the fourth quarter. Do you think that with fourth quarter and like you were talking about with the consumer, we're going into the holiday season, we're going into Christmas shopping. This is the time where a lot of retailers are hoping to make up for whatever they didn't do for the last 10 and a half to 11 months. What do you think fourth quarter is going to be?
Well, for us, you're probably going to scratch out for the S&P 500 as a whole a minimal amount of earnings growth. The holiday shopping season, we're not expecting any fireworks there. As I just mentioned, for us, I mean these consumers are pretty tapped out now. The high end, if you look at the top 20% of the income scale, they're probably going to be out there spending money, but the other 80% are pretty tapped out. Are they going to spend some money for Christmas? Yes. But do we expect it to be a big selling season where we really see volumes and earnings really increase relative to next year? We're not expecting that.
Let's say sales will not be as big and robust as in the years past, which also that means tax revenues, sales tax revenues will be down, and also government funding coming in from the government. Do you think that means also that the deficit, which is already more than we're taking in, will only grow larger?
Well, I think the deficit, unfortunately, is going to grow larger. I don't have a lot of confidence whether on the Republican or Democrat side that these guys can really rein in the spending. So tax revenues, there's been a lot of news out over the last week or 10 days that tax revenues are down. When you have a slowing economy, that shouldn't be a whole lot of a surprise. But tax revenues are going to be down probably for over the course of the next couple of quarters, just due to a slowing economy. So the deficit, we're going to battle over this, and the government spending train doesn't look to me like it's going to slow down anytime soon.
Well, normally in the past, I think since 1976, I think we've had something like 15 or 18 of these government shutdowns and also threats of it. And now the market usually just kind of like ho-hums and doesn't really have any kind of a big problem with it because they know it's going to be resolved. Do you think that with all this that's going on right now, this will be the same status quo, that it won't have that much of an effect on stock market?
Well, I think it will be pretty much the status quo, and it always for a few days, Andre, as you well know. There's a little bit of turmoil for a few days around it, but we do know that something is going to get done. Spending is not going to be dramatically cut, and the can's going to be kicked down the road. So I expect a little bit of maybe a few days of some turmoil there, but they'll get enough agreed upon where they can have some sort of a continuing resolution, and we'll just keep rolling this thing out.
Would you advise clients to have more cash in reserves for those downtimes, or would you prefer them to be more in equities?
Well, I tell you what we want to do is we backed a little bit earlier in the year. I think it was back in May. We took some money out of technology sector. We took some money out of equities in general, and that kind of traditional 60-40 moderate growth and income portfolio. We're more like 50-50 right now, especially anywhere north of 4.25 on the 10-year yield. We think that's attractive. So what we've wanted our clients to do, what we have been recommending, is that you keep that cash in that short-term parking spot in the treasury market, so that if and when we do get the pullback that we expect, that you're going to have some ammunition to jump into the market and stick a toe in.
Well, I remember, again, going back about 5 weeks ago, maybe 6 weeks, you had said that you thought the technology sector, the risk was too high at the time. So when do you think that they're going to cut? Would that help sectors like technology or REITs or sectors like that would grow with a lower interest rate?
Yeah, I think the technology sector clearly is going to react positively to lower rates. Higher rates are not going to make technology investors happy. So for right now, given what's the rally that we've seen in the bond market and the drop in yields, the technology sector has been pretty good on this bounce. But certainly pullbacks. That's one sector we would be looking to overweight for sure, because we do think as we move into next year, and through next year, inflation is going to continue to go down. We do think in the second half of the year, the Federal Reserve is going to be lowering interest rates, but they're not going to be in a big hurry to do that.
Do you have any thoughts at Wells Fargo of when or around what time they would be lowering, depending on
I
what?
think it's going to be after. It's going to be probably after June. For us, if we had to map it out, we would have a recession that would start either very, very late this year or in the early, month or two of next year. That lasts somewhere between 6 and 8 quarters. The Federal Reserve, could they begin cutting rates in June? That might be a little bit early. But based on what we're looking at, if they maybe start to cut in September or something like that, that wouldn't surprise us at all.
Scott, in your position, we've got a lot more data that's going to be coming up. I mean, we've had the October jobs reports, as we'll have the one for November in about 3 weeks from now. We'll have JOLTS. We'll have more CPI, more other types of data that will be released. But at the same time, you've got things that are happening around the world. And now I'm thinking about Ukraine, China, Iran, other types of events like that. The debt ceilings deficits that we're talking about. Are you more concerned on data that's being released from that, such as those that I'd mentioned, or are you more concerned about that unknown element of the black swan of Iran, China, Ukraine, others like that?
Yeah, I think the part with these black swan events is, they're very hard to predict, and they're out there, and you can theorize what might happen, whether it's some escalation between the Israelis and Hamas that gets into a bigger regional conflict, China and Taiwan, Ukraine, Russia. But the problem is, if you ask me, for instance, what's the probability that the Israelis, take out a few Iranian oil refineries? Um, I'm guessing, and I think strategists, don't like to guess. And on these black swan events, I mean, if you ask 10 people what the probability is of that happening on our investment strategy committee, you could very well get 10 different guesses at the probability. So I think that's the problem with trying to think too much about black swan events, because there's always a lot of things that can happen out there, but we have to invest in the now and then based on what we're seeing looking forward. And that's, of course, why you try to have a diversified portfolio so that you don't have all your eggs in one basket. You're not making one gigantic bet. And if you're wrong and something does happen that you thought was a low probability event, or something that you didn't even think of that might happen does happen, that you're not just completely exposed and completely wrong. So asset allocation is all about grinding it out, being in the market over time, not having all your eggs in one basket, especially when you have so many different things going on around the world that seem like they could suddenly explode into something that's not a good thing.
Scott, when it comes to diversification, I mean, except for maybe the person who has the inheritance, or maybe a person who makes a land sale that has a lump sum, I would imagine the average investor, they're having their weekly paycheck, and at the end of every month they have some money coming in, or at the end of every year they have some money that's been saved. When you talk about diversification, do you think that it's better to be, at the end of that month or the end of that week, add on to what you presently already have to make those areas larger? Or do you think that it's better to diversify and having either better areas and more localities?
Well, I think that for most investors, you tend to have a home country bias. So most U.S. investors, they have most of their investments in the U.S. But as we look down the road, and especially as we look far down the road, probably most of the growth is not going to happen in the Eurozone or in the U.S. It's going to be in the emerging world. So I think you want to have some exposure there. For most people, the foundation of what you hold is U.S., probably large cap stocks, but a mix of U.S. stocks. And so when you get your regular paycheck and you do some regular investing, I think that's all good. When stocks are down, when they're down a bunch, I'm not talking down 5%, but when they're down, let's call it 10+%. And if you do have some excess cash that you want to eventually get into the stock market, you need to buy stocks when they're down. That's the hardest thing to do, is to buy stocks when you're really nervous about the
Because
stock market.
most
If
people
you have
want to
that
sell when
three
they're
or
down
five year,
and
yeah, I
buy
mean,
when
if
they're
you
up.
have a 3 or 5+ year time horizon, you want to buy stocks when they're down. I mean, when everybody loves stocks, your friends, you, CNBC, any of these other networks these financial networks that are out there, when everybody loves stocks, that's probably not the time to buy stocks. You want to buy stocks when people don't like stocks.
Scott, I was gonna ask you a final question of what's the greatest mistake investors make, but I think you kind of just answered that, didn't you?
I think investors, they consistently buy stocks when they're high or at their highs, even though they have a long time horizon that they're looking at, rather than buying stocks when they're down and people don't like stocks.
Scott, I had a great time. I hope you come back.
All right, Andre, thanks a lot.
Thank you, Scott. Hey, if you've got a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it piffy, and write us at andre@benecapital.com. So now for a wrap up on Wall Street. Well, Thanksgiving travel is expected to be heavy this year, with over 55 million people headed to the highways or the airport, with those traveling 50 miles or more. American Airlines is expecting just under 8 million this coming weekend, followed by Delta and United starting on Wednesday and ending on Sunday night. TSA is estimating that 30 million to come through inspections, so you may want to get to the airports early. And they are expecting a new one-day record of travel for that Sunday night after Thanksgiving of almost 3 million air travelers. Well, Thanksgiving is this coming Thursday. And you didn't need me to tell you that, I know. Well, this year, according to the American Farm Bureau, the typical feast for Thanksgiving for 10 will be coming to at $61.17 for this year. And it's a 2% increase from last year and an 18.5% increase from 2021. So as of Monday, we'll have 28 trading days left in 2023. Will we be having a Santa Claus rally, or has the rally since November the 1st been the Santa Claus rally? Are stocks really getting overpriced? Well, next Friday, we're going to be talking to the founder and chief investment officer of Treasury Partners, Richard Saperstein. Barron's Financial has rated Richard as one of the country's top 100 financial advisors for the last 10 straight years, with $21.2 billion in assets under management. Richard Saperstein, he's next week. And that's a wrap-up for our show for this Friday, November the 17th. Our thanks to Scott Wren for being with us tonight. But as always, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love, and a happy Thanksgiving next Thursday, too. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music. And now, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.